Good afternoon, everyone. Today's webinar presented by Akram Associates is Tax-Efficient Hedge Fund Strategies and Management Code Taxation. Panelists for today presenting this webinar are Mohammed Akram and Alex Cummings of Acadia Family Offices. For CPE credit qualifications, you will need to participate for at least 50 minutes and answer 4 of the 5 polling questions. If you should have any problems during the webinar, please identify the problems in the chat. And if you still have some troubleshooting issues, maybe if you have VPN on, you can turn them off. And any questions directed at Mohammed or Alex, you can direct them into the chat. Have a great webinar.
Jackie, I appreciate that intro. Before we start, Alex, why not I can make an intro for myself and then you can introduce yourself.
Okay.
I'm a founder of Akram Insurance Advisory and Tax Firm, and we provide accounting, audit, and tax services to hedge funds, private equity, venture capital, and family offices. And today I have Alex with me coming, so he will make the intro. Alex, go ahead.
Okay. Thanks, Mohammed. My name is Alex. I'm a partner at Acadia Family Office. We are a boutique accounting firm that focuses on high net worth individuals and those in the alternative investment space. We provide tax services for principals, management companies, special purpose vehicles, and similar entities, and accounting services such as outsourced CFO and financials, bill pay, and similar things for the families and their entities.
Okay, so it's time for the first polling question. So let me start the first polling question. It will take a lot of time. So our first polling question was that are you a fund manager, and 65% said yes. So that was a good mix of people here. Conversation. So the topic is tax efficient hedge fund strategies, and effective tax planning can accomplish much more than just saving income taxes for current and future years. So the tax planning can also maximize the amount of funds which you would have available for retirement, reduce future regulation, reduce eventual state taxes, and assist you in managing your cash flow to help you meet your financial objectives. So this is the first strategy which Alex, I will ask you to share with us.
Sure. So many folks are probably familiar with the Internal Revenue Code Section 1061 that was enacted a few years ago. And this makes it such that persons that have an applicable partnership interest must have a holding period of 3 years to receive the long-term capital gains tax rate. That makes it more difficult for the tax advantages of a typical carried interest to sort of pay off for the manager. And there's a few considerations here. As indicated on the slide, sometimes if you are a manager that's not going to get to that sort of 3-year mark, it may make sense to consider changing your fee structure and just go to, especially if you're a trader fund, go to a incentive fee. It's going to be taxed as all ordinary income, but the term's going to be a lot less complex, and you may be at the same net tax position anyway. The other thing to be aware of is that any investment that you have in the fund that has qualifying basis is not subject to that 3-year holding requirement. So one of the considerations is in your tax return process, your GP capital account in your fund, a portion of that has already been paid taxes. So if you have $1 million incentive in year one and 500,000 of that is taxed to you, you have $500,000 of qualifying basis. The return on that $500,000 in that next year is not subject to the 1061 calc. So that helps reduce the reclass to short term. And it creates a little bit of a challenge because you then have to apportion, whatever amount of long-term capital gains that are between 1 year and 3 years to that law. So that's a conversation to have with your administrator and tax return preparer to make sure you're getting the most benefit.
Awesome, thank you. So let's, because this is a very difficult year for a lot of fund managers and taxpayers, because 2021 was one very fabulous year. Everyone made a lot of money. 2022, obviously, the market is down and most people have some unrealized losses and realized losses. So, Alex, what would you recommend that how they can do the harvesting of losses?
Sure. So typically, this is something most hedge fund managers are aware of, or even investors, and that's you want to try to get to that long-term capital gain 1 year holding period, or in the case of an incentive allocation, a 3 year holding period. And you also want to be sort of aware of your total taxable income versus book. So 2022 is a good example. It's a challenging year for the market, so a lot of fund managers are down from a book perspective, and they may find that they have closed some positions that were winners and realized some taxable income. So that creates a double sort of whammy where you're down on the year, but you have taxable income for investors. So it's always a good idea to consider tax selling, and the considerations in these examples are, are there unrealized loss positions that you'd like to sell before the end of the year to reduce taxable income? And in doing so, you have to be concerned about generating a wash sale. So if you sell a position that's down, you need to wait to 30 days to re-enter the position, or that loss will just be temporarily disallowed, and it would be as if you've never sold it. The other thing to consider is if you have a unrealized loss in a position that you're going to continue to hold, if it goes longer than 1 year when you sell it, it'll be if you don't recover that loss, it'll be a long-term capital loss. Long-term capital losses offset long-term capital gains first at the individual taxpayer level. So a lot of managers would be prudent to not only look at positions they have, but just maybe they want to take a loss in a position before it gets to that 1 year mark, even if they're going to re-enter it. Again, you have to be aware of the wash sale rule to make sure you get the taxable loss.
I think the standard rule will also apply in that situation, harvesting wash sale losses.
I'm sorry?
All the standard rules will apply on when they're harvesting the losses too.
Yes, yeah. So, harvesting losses, there's really two goals. It's just bringing down taxable income, avoiding a wash sale loss, of course, while doing that, and then also, preventing a short-term loss from turning into a long-term loss. Because if it ends up being a loss, then you're better off offsetting short-term gains instead of long-term gains.
Awesome, thank you. So obviously during the TCJ, a lot of people are aware of that, that the under schedule itemized deduction exceeding 2% of your AGI is no more deductible for the individual investors. So that causes a host of issues for investors who are investing in those funds. Alex, can you shed some light on what are the options they have now?
Yeah. Yeah, so this is a tough one. There's not a ton you can do. It used to be the losses were allowed to the extent that they exceeded 2% of your AGI. So a lot of investors did get some benefit for it. But if you're in a fund that's considered an investor rather than a trader, your management fee, your share of management fees, operating expenses like admin costs and legal, audit and tax return, all those things are effectively going to be non-deductible. So the strategies that investors use, you're sort of limited to what the fund is able to do, but mitigating expenses or keeping your expense load low. So some managers are charging a lower management fee and a higher incentive to kind of make that a little better benefit there. Some managers will have the investor pay the management company directly, which means that it's not going through the K1. Arguably, that could still be characterized as a non-deductible expense, depending how it's paid. And another strategy would be to consider investing in, if the fund has an offshore option, it could be, if you have an offshore fund that's treated as a passive foreign investment company or a PFIC, and that PFIC can provide you with an annual information statement, portfolio deductions are netted against ordinary income. So that's an interesting option. Not a lot of taxpayers are aware that you can invest in an offshore fund and still get long-term capital gains. And there are some other sort of changes that would be important to make sure you understand. But if you have a high portfolio deduction fund, then investment at the offshore feeder can be a really effective strategy to get those benefits. I think we talk about that next in a later slide. Oh, here we have it. Okay. So, yeah. So the question here is, if most fund complexes that have an onshore and an offshore fund, the offshore offering memorandum indicates that it's for U.S. tax exempts and non-U.S. persons. But if they would allow you to invest and they can produce a PFIC statement for you, which would come from the tax return preparer, then you're going to get basically two numbers on that PFIC statement. Your PFIC ordinary, which is your net of all your interest, dividends, short-term capital gains, or anything that's taxed at the higher marginal rates, and PFIC capital, which is long-term capital gains. So in doing the comparison, if you look at K1, anything that's on that K1 that was a portfolio deduction will reduce your PFIC ordinary. So it can be an effective tool there. There are also some deferral elections with a PFIC if you get an annual information statement, where you can actually elect to defer the payment of tax, which allows you to compound those earnings that you otherwise would have used to pay your tax liability into the fund. There is an interest charge, so you would be charged interest at the prevailing rates, but provided that the fund return is greater than the rates, you're actually and making more money than you otherwise would have. So that's also another sort of not widely known benefit of investing in a PFIC. The other thing we have here is, if you have a family office where there are significant family assets for the family members or trusts, if there is an active management of those assets, you could form a management company and charge an incentive and have the management company sort of pay all of the expenses. So the way this might work is, all the expenses that are paid to accountants or advisors or investment managers normally would be a portfolio deduction. If you then say, we're going to have all those expenses borne by the management company, and in turn, the management company is going to receive an allocation of income, then those expenses will net against that allocation of income on that management company tax return. So it costs a bit of money to get a structure like this up and running. There's a bit of legal fees. There's ongoing maintenance, a bit of compliance. So the tax benefit, based on some other clients that we've worked with, tends to be around $1 million of overhead. So if you have overhead in your family office of at least $1 million, a family office structure can start to make sense.
Usually in those situations, Alex, would you structure as a C corp or the different? Because we have seen mostly our But Rose Family Office then registers a C Corp, and then the issue is that how they can make a justification since the real business.
Yeah, that's a good question. Yeah, so for this to work, typically it needs to be a corporation, C Corp. So sometimes it's an LLC that checks the box to be treated as a C Corp, but effectively you're filing a corporate tax return. And, you know, one of the benefits of an incentive allocation is you get the lower capital gains tax rates. That's not going to apply in this scenario. We're really just using that incentive allocation to reduce the taxable income of the family members. And then that flows over to the management company to be revenue, which can be offset by expense. So, you know, you are filing a corporate return. There would be quarterly estimated taxes due. And there has to be some difference in ownership. So somebody has to own that management company that has a sort of profit motive. So often what we see is, you know, let's say the family's multi-generational, 2 or 3 generations. There could be 10 to 30 taxpayers in there. Most of those folks are passive, and there's probably a few family members that have sort of taken on the responsibility of managing the assets of the family. Those folks would be the owners of that management company, and then over time you should show some profit. So it has to be a bona fide business.
Right. True. I mean, we have seen in most of those situations, the goal is to get a break even, right? Don't show too much loss, but don't show too much profit. So structured in such a way that your expenses can be deductible.
Yeah, and the benefit to the family the most, a break even is the answer, right? So you just run the risk of the IRS challenging the structure and saying it's not, you know, an actual business. So that's where I think many people have heard of the lender case, which is lender bagel. So that family basically did this strategy and went to tax court because the IRS said that it wasn't a real business, and the lender family prevailed. So that's kind of the blueprint, but it is very complex, and you know there is some risk to being challenged. So it's important to try to make sure that you consult with good advisors and you know pay close attention to it. And you know at the end of the day, you should be showing a profit over time, and there should be a separation of ownership between the management company and the family members.
Right. Awesome. That's a great insight. Okay, so it's time for second only question. It will be very simple. So people who watch University. Okay, so it was a very simple question. Was you listening? So mostly said yes. So this is 475 election mark to market. So Alex, could you tell us that what's the difference between investor and trader, and which traders are eligible to make 475 election
Sure.
mark is eligible to make, and what's the purpose for that?
Sure. So the 475 election primarily is going to benefit your very actively managed portfolio type trader. So this is somebody that is mostly in positions for a very short-term gain. They have very low to zero likelihood of generating a long-term capital gain, and somebody that is in that sort of description probably has a lot of risk of generating tax adjustments which are unfavorable, like wash sales, straddles, and similar issues. You know, basically, wash sales and straddles take economic losses and sort of defer them from a tax perspective, because there are certain strategies that you could undertake that are just to generate a tax loss. So those rules were put into place to prevent people from selling a stock, taking a large loss, and then getting right back into it, for example, or hedge positions. Let's say you've got you're buying some puts to protect unrealized gains on a long position that you've held for a while. The loss on those puts expiring, they're going to disallow temporarily. So for somebody that's never going to get to sort of a long-term holding period where you would generate a lower tax rate income and are potentially generating wash scale adjustments and straddle adjustments, the 475 election is really going to help you. So what that does is you treat all positions as if sold on the last day of the year, so everything's marked to market, and the income or loss is ordinary trader business income, not trader business in the sense of being effectively connected to a non-U.S. person or state source to a non-resident, but to the extent that you're generating losses, they're fully deductible. There's no limitation. Capital losses are limited to being a deduction $3,000 over and above any capital gains you have. So, a trader that's active, generating a large capital loss, they're going to pass through losses that potentially are going to carry over for years for their investors. So the 475 election eliminates washdowns and straddles, converts it to ordinary, and you get to fully deduct it. So for somebody in that profile, it's kind of a no-brainer. A few other considerations. It used to be the 475 election was irrevocable, so it was sort of concerning if somebody made the election and then let's say their strategy changed and they no longer were actively trading, or they were going to invest in some things that could generate long-term gains. There was a concern that, hey, if we make this election, we're stuck with it. Well, the IRS changed the rules a few years ago. You can actually, there's a revenue procedure where you can have the election revoked. It does cost a bit in compliance fees, and you have to essentially follow the procedure to get the election revoked, but it does work. The other thing to consider is the language in the election mentions that you can apply it to a particular trader business. So a multi-strategy fund could, for example, have a actively traded portfolio and also have a buy and hold portfolio. So if it's done in a proper manner, you can have that 475 election only apply to the activity that makes sense, and that's that sort of actively traded piece, and then have a portion of your portfolio generate unrealized gains, long-term capital gains, and other similar income. What's interesting about this, two sort of caveats, you have to meet the definition of a trader. So you have to sort of have, effectively trading almost every day. If let's say you sort of held positions for a week and then did all your trades every Friday, for example, arguably the election wouldn't apply. So you have to make sure that you really qualify as a trader first. The second thing is, with a lot of folks in digital currency or digital assets, those are not, they don't really, it doesn't qualify. So like the way that the rules are currently written, somebody that's a crypto trader isn't eligible to make this election. And we're aware of some funds that sort of take the position that it's reasonable to apply. Anybody here that's in digital knows there's a lot of challenges in getting good reporting information, cost basis and proceeds and some of the information that you might need to get a good return out. So by matter of practicality, some people just say, listen, arguably this doesn't apply. We think the IRS, if they looked at it, would allow us to do it. So we're going to make this election and sort of apply it. Some folks from the IRS that I've spoken to that are kind of in the know, they sort of view the 475 as a friendly election. In other words, it eliminates so many potential abusive practices for generating tax losses that they're sort of not going to fight you on it so much. Like if you're saying we're going to mark everything to market, we're going to treat everything realized and unrealized as taxable, and it's going to be ordinary, that's a good result. It makes taxable income equal book, and there's not a lot of opportunities for abuses. So they're sort of the unofficial record is that they're not that interested in challenging it, just as a blanket rule. The other thing that's important, the 475 election, is when can you make it? If you're it's an initial year of your trade or business, you should make the election by the time you start the activity. What's interesting about it is the manner in which you make election is you put a statement in your quote unquote books and records. So it's effectively a document, probably on your company letterhead, that you have the language for the per the regulations, identifying the trade or business, identifying the taxpayer, identifying when it's effective, sort of signed and dated, and then you attach a copy of that to your tax return. Because it's not an election that's affirmatively filed with the IRS, there's a little bit of sort of how do you prove it type of thing. So, there is some potential for the IRS to be concerned that you're abusing those lax rules. For example, let's say a fund launched at the beginning of this year and was intending on not being a 475 election fund, and then they realized that they're down, say, 30%. And they said, if we make this election, we can pass through all of our losses as ordinary to our investors rather than capital losses. We're going to go ahead and do that. Technically, it would have needed to have been in the company's books and records the day that you started. So there's always a little bit of concern about that. Like, if you were challenged on that, how would you prove that to the IRS? So that's just something to be aware of. The other thing to think about with a 475 election is if you're an existing fund and you want to make it, it sort of applies for that next year. So like if it was, let's say your fund started in 2020 and you traded for 3 years and then you realized, if we look at our activity, it's really very heavily traded. We have a lot of concerns with wash sales and straddles. We probably should make this election. You would need to make it with a filing of the 22 return to apply to 2023. And then there's an adjustment process to get there. So the timing of the election is important to consider.
Awesome. Yes, because a lot of time people come to us and the train has already left the station. You can't go back and make this election valid. So valid election at the right time is key to offset your all the loss and losses, right? Okay, so let's go to the other section, another election, which is more relevant for the currency traders. So go ahead.
Yeah, so this is a lesser known election as well. If you're trading forwards, the sort of the default classification is typically it's ordinary income or loss. So if you're trading, let's say, a US dollar or euro forward, the gain or loss on that's going to be just ordinary and mark to market as well. If you were to trade a US dollar euro futures contract, which exists, that'll be taxed as Section 1256, which we're going to talk about a little bit later. But that's 60% long-term, 40% short-term tax rate. So it's a preferential tax rate. So the benefit to the 988 A1B election is it takes any forward contract that has a regulated futures contract equivalent and taxes it as the same as that futures contract. So effectively, you can trade forwards and futures and have everything be 1256, which is you're getting some long-term capital gain benefit there. Couple caveats here. The manner in which you make the 98 A1B election is trade by trade, and you're supposed to affirmatively confirm with a broker when you enter the trade that the election applies. With clients that we have helped make this election, they reach out to their broker and you say, hey, I'd like to apply this election to some of these trades. They never know what you're talking about. There's really no mechanism to do it. So practically what that means is we typically recommend that they provide some communication to the broker saying this is a tax election. We need to notify you that it's our intent to have it apply to these particular trades as we enter them. I don't need you to do anything other than confirm receipt of this communication. So you send them an email, you send them a certified letter, something to just prove that you notified them. Also, from a practical manner, most people, if this applies, they sort of apply it blanket to all their trading, right? You wouldn't necessarily pick a forward versus another. If it's a good thing, it probably applies to all. So practically speaking, it tends to be a blanket election, and the language would say something to the effect of, we intend to have Section 988A1B apply to every forward contract traded in this account from this date until we revoke it, and then sort of just follow up on an annual basis and reiterate that. So if there ever were to challenge it, you can sort of prove that you've affirmatively made that election. What's also nice about it too is if you decide that it doesn't make sense for you given your tax circumstances, you can simply notify the broker that you don't want it to apply anymore. So it's very easy to opt in or opt out. One of the other things that we have seen with this that it's a little obscure is if you're a fund that trades forwards and you're more of a buy and hold, so you're an investor fund instead of a trader fund. If you have ordinary losses from any investment activity and it's not a trader business loss, you run the risk of that loss being lost forever, because a trader business ordinary loss creates an NOL. But if it's an investor ordinary loss and you don't have sufficient investor income, it becomes a deduction you don't get to carry forward into a future year. So there's no provision for carrying forward investor ordinary losses. So the 988A1B election is helpful because 1256 is capital. So if you have a 1256 loss, it doesn't offset other ordinary income, but it does become a carry forward. So we had one client that had some trusts that were, their only investment was a fund, it was a family office fund, and they had some forward contracts exposure that had lost money, and there wasn't sufficient ordinary income to offset, and they actually ended up losing a deduction in that year for the forward losses. So we helped them work through a solution, and that was to put this election into place so that if that ever were to come up again, it would be at least a capital that would carry over.
Because most of the 1256 losses, I don't think so you can carry back anymore under the new tax law, right? You can still have for certain years.
Yeah, they did have a rule where you could carry it back, I think 2 years. But they may have changed that. That's another good point. We can touch on that a little bit. That there are some carryback provisions, or there were for the 1256.
Okay, let's go. We need to go down. So here is right. So this is a private placement life insurance, right? This is more for fund managers who are managing more than at least closer to $100 million, and in most cases, the LPs are very concerned about paying taxes because they're living in the high tax jurisdiction or high tax state. So you run this fund under the wrapper of insurance policies, or PPI, or private placement life insurance. And this fund's called Insurance Dedicated Fund. This is not for every fund manager, but if your LPs are very about paying the taxes, there's a cost to maintaining that. That's what $7 million and above, because below that, the cost of maintaining that kind of structure will not give the benefits of saving taxes. The opportunities, right? Can you share some light on that?
Sure. So many folks are familiar with the opportunity zones that are out there, and basically the TCGA provided an opportunity where you could invest into a qualified opportunity zone fund or a qualified opportunity zone business, and the dollar amount of your investment would defer capital gains equal to that amount. So if you had, just by way of example, $1 million gain on a stock that had a basis of $5 million, you sell that stock, you basically get $6 million back. You have $1 million of capital gain. You could take $1 million and invest it into an opportunity zone and fully defer the capital gain on that trade. So you basically just take your gains and invest it into an opportunity zone fund and defer. The opportunity zone, I think, carries through 2026. So this started in 2018, and some of the earlier investments had a provision where gains that you generated on that investment could be partially or fully exempted. That window has closed, but you still do get the benefit of the deferral on the capital gain. So it's a pretty powerful tool for pushing income to a future year. That investment in that opportunity zone, whenever it's liquidated, that gain would come back into taxable income.
Okay, awesome. So that's for the next polling question. Right? It will be very simple. Okay. So we asked this question, are you listening? Majority says listening, only 10% says no. Okay, 1256, I think this is a good way to, and then some of the participants are asking some questions, and we will discuss those questions at the end, so we will make sure we have enough time for that. So here, I think we can discuss the 1256 contract and also the podium for carryback. Alex, would you like to shed some light on those 1256 contracts? And somehow Alex is mute.
Okay, there we go. Thank you. Yeah, I was muted there. Sorry. Yeah, so we touched on this a little bit earlier when we talked about the 980A1B election, but regulated futures contracts, which are effectively any U.S. exchange futures contracts, so NYMEX or CBOT, your oil contracts, grains, sort of all the things that we see out there as futures receive this 1256 treatment. There's also a number of non-U.S. exchanges that have applied to submit to IRS reporting for futures contracts, and they also receive that treatment. So I think like the ICE exchange is one, and there are some others. But effectively, when you're trading in futures contracts that are 1256, it's mark to market, meaning that whatever unrealized gain or open trade equity you have in that contract is treated as sold for tax purposes at year end. And 60% is taxed as long-term capital gain and 40% is taxed as short-term capital gain. So you could enter into a futures contract and you held it for 3 days, you're going to get 60% of this long-term gain. So it's a pretty good deal from a tax rate perspective. There may be some capital loss carrybacks that we mentioned before. That would be something to check into. But it's a relatively straightforward tax regime.
Here is an exception for currency contract, but on the other side, you told us that we can make this election when convert ordinary gains into that, right? So usually it won't fall into that category by default, but making an election, you can make this.
Yes. Yeah. You would treat all forward contracts that have a futures contract equivalent, a regular futures contract equivalent, as 1256. So it's effectively the same.
Okay. Awesome. Okay, let's go to the main topic, the management company considerations, right? Because most of our fund manager clients always want to make sure they're paying the minimum taxes under the tax law. So PTET, right? So I can shed some light under the TCJA when the Trump first term. He introduced the concept of SALT, state and local tax limit of $10,000 under automatic deduction on Schedule A. And that really caused the whole issue that PTET come into the place, and there's a preview notice by the IRS. And I would ask Alex to shed some light on that, how they circumvent the SALT deduction of $10,000 United States.
Sure. So this is really in response to the TGCA, which limited the Schedule A deductions for state taxes paid to $10,000. So if you're a high earner in states that have a high tax rate, New York, New Jersey, California, from a U.S. tax return perspective, your ability to benefit from that deduction is limited to $10,000. That was sort of a huge hit to residents of that state. So what states started to do was create an entity level tax at a partnership, which provided for a credit. So we'll use New York as an example. They have the New York PTET, where if you opt in, which you have to opt in by March 15th of every year, let's say in a management company situation, let's say it's New York management company has partners. If they opt in and make quarterly estimated payments, there's a graduated set of rates, but let's assume a flat 10%. If they have $5 million of management company income for New York purposes, they'll have made PTET quarterly estimated payments of $500,000. What that does is it creates a deduction equal to the amount paid in for federal income tax purposes. So it's just an expense like any other you might report in your return. It reduces your line one income. So instead of line one income being $5 million, it's $4,500,000, and you get that federal tax benefit on that $500,000. That money goes to the state of New York and becomes a credit on your New York return. So effectively, let's say Muhammad was a partner and his share was $50,000. He has $50,000 less federal taxable income and a $50,000 credit on his New York return. So it's a mechanism where the entity itself pays the partners a portion of the partner's New York tax liability and reduces their federal income. It's a pretty powerful tool. The notice here mentioned on the slide basically it was from the IRS, and they sort of blessed that this did work. So there could be some forthcoming regulations on it. There is some risk in some scenarios, but for a management company, trade or business situation, it's pretty much a slam dunk. So if you have state source income from, there's a number of states that have adopted it, New York, Connecticut, California, New Jersey, to name a few, I think Illinois, even a lot of smaller states have done this. From a state's perspective, it's taxpayer friendly. They don't want to see their residents that are working and paying taxes flee the states that have no tax or low tax rates. So this is something they put in place to mitigate or offset that federal tax rule. So really almost every client that we have that has exposure to these states is doing this, unless there's some reason not to, but most people it's pretty straightforward. It does complicate the return. It does you will incur a little more compliance costs. You do have a quarterly payment requirement, and there are some nuances to consider. Sometimes people will have, let's say you have a management company that generates a lot of income, and you make a PTET payment, and then you have an investment in some other entity that loses a lot of money. Your net taxable income to the state will be the net of those two numbers, but you may have had a lot of capital paid in the state, because there's one entity that has a big profit and another one that has a loss, you're going to be out that capital. It does create a federal tax deduction, but then it'll be a refund for the state. So, it's important to take a step back and look at each taxpayer's total tax picture to see that it makes sense. And a vacuum entity by entity usually does.
Okay, awesome. So this is the other area which is not regarding the management company, but the qualified small business stock, how we can utilize the taxpayers can utilize for the benefit.
Yeah, so the scenario that we most often see this, so qualified small business stock is essentially sort of original issue. You see it in venture capital, small companies. Think of, the folks that were at Tesla when it first started, when, they're probably awarded a lot of stock units at a low cost or no cost. When there's an opportunity to monetize that, you can make an election, provided that it qualifies as a QSBS, qualified small business stock, and effectively get a lot of that gain to be not taxable. So there's an election that you have to make. Stock has to qualify. Sort of the takeaway here is, if you're a venture capital investor, or you have a client or a person that works for one of these companies that has the good fortune to have the stock appreciate quite a bit and be involved in a sale or an IPO, there's some really good tax benefits to it. So you should check with your tax advisors to see if it qualifies.
Awesome, thank you. I think we have already discussed qualified opportunity zone. So now is the excess business loss limitation.
Sure. So another provision that came into play with the TGCA is excess business losses. So high level, $500,000, it titrated up to $540,000 for 22. You're allowed a net excess business loss is a married filing joint of $540,000 in the current year. Any amount that's in excess of that is temporarily disallowed, and it carries over as an NOL. So if you start a management company and it's the first year, often they are not generating a gain just because it's the first year and there's a lot of overhead and not a ton of revenue. You may not get the full benefit of that in that year. This also impacts investors in trader funds. So if you're invested in a fund, we talked about the 475 election earlier. If you're in a fund that has made the 475 election, that's considered trader business income, and that loss very likely is going to be considered a second 461L loss. If you had $2 million 475 loss in a particular year, if you didn't have other ordinary income or other taxable income to absorb that, you're only going to get $540,000 in this current year. What's a little odd about it is the way that it works is it just becomes an NOL in the next year, and you'll get to deduct 80% in that following year. So it's a little ineffective, honestly, because it's like a 1-year deferral of that excess, and then you get most of it next year. So it's really something to be aware of. I think the real risk is you underpay estimated payments because you were counting on a taxable loss that exceeded this limit, and it just threw you off. You get most of the benefit back in that following year. So I think that's kind of the real risk.
Agreed. Okay. So hopefully some last polling question, and let me ask this. Last polling question was that you join the webinar, so majority of it says yes. This is the last topic at screen we have, and then we'll go for a couple of questions here. Because we have some 5 minutes more. This is more in line with the management company and the bonus depreciation. Would you tell Alex
Sure.
that only 22 days left if someone wants to take a bonus depreciation this year?
Yeah, so bonus depreciation has been around a long time. It's been used as a tool legislatively to sort of be a stimulus of sorts to encourage businesses to not hold back capital that they wanted to invest. So it's I would say at this point, I think it's been around for 4 years at the 100% level, and unlimited amount. And then they have they sort of changed the rules, so it's property. The useful qualifying property would be anything with a useful life of 15 years or less. And they changed a few rules with like leasehold improvements, for example. Qualified leasehold improvements it's pretty easy to get things to qualify as there. So it creates an ability to spend an awful lot on your business and take a full deduction for it. That's the good news. It is titrating down, so it's 80% of the price in 23, and then that 20% difference will just be depreciated over the remaining useful life. And then down, you can see here on the chart, 20% each year until 2027. So just be aware, if you're counting on it, that it's not going to be the full 100% starting next year, and down from there. The other thing that is a surprise for folks, and we actually saw this past year, is certain states are decoupled from this deduction. So what does that mean? That means that they don't allow it, and then the depreciation at the state level is going to be whatever the rules are. So if I'll give you an example, let's say this applies to a New York resident. So New York does not allow bonus depreciation. So we had a client that was a very significant investor in a real estate partnership, and that real estate partnership purchased a property, made a significant investment in it, and turned that property into sort of high-end rentals. So for the 2022 tax year, there was a very significant line one loss that was driven mostly by bonus depreciation. So in the New York K1, there was a massive sort of add back because it wasn't allowed as a deduction. The New York personal return starts with federal income and adjusts up based on addition. So they lost money on this, and they lost money in this investment, but had multi-millions of dollars of New York taxable income. So it created a situation where they lost money, but had a New York tax liability. So fortunately, it was called early enough that we could go back to the tax return preparer for that investment partnership, real estate partnership, and they were able to amend the return to opt out of bonus. The other thing that's important to point out is bonus depreciation elections it's the default. So you have to effectively opt out of that treatment. If you don't, it's the default. So for New York, for example, Section 179, which is what people used before bonus came out, allows you to just expense business property acquired during the year up to the limit of the 179 property, which for 2022 is $1,080,000, 1,01080. So for New York, if you had $800,000 of property that was purchased, you may be better off opting out of bonus and instead electing Section 179 treatment, because you're going to get the same federal deduction and you'll get a deduction for New York versus bonus depreciation. You get the federal deduction, but then an add back for New York purposes. So things to consider.
Overall, it really depends on your state tax residency of the taxpayer, right? If your state is decoupling with the federal, then you should consider what are the best options are, right? Yeah,
you should talk with your tax professional and ask them, should I do bonus? Would I be better off using Section 179, or can we consider the state tax implications of this bonus depreciation?
Okay, so I think that's pretty much is all our slides. We have only a few minutes left. So one of the questions person asked that during this, do we foresee any tax law changes coming on our way which can impact what we're discussing today?
That's a good question. Mohammed, I don't know if do you have any thoughts to add?
For me, like especially the house is flipped now. I don't see a lot of changes happening between now and 2024. Depends who wins the election again after 2 years. But there are a lot of things in the works, like they might not pass that. Right? They want to overhaul incentive fee. They just weaken incentive fee, but they didn't eliminate that. You can still private equity, venture capital can still get those deductions only that hedge funds are not getting a long-term capital gain.
Yeah, I agree with you with House flipping to the Republicans. I think it lessens the chance, and we certainly not heard of any major news. I think when the presidency changed in 20, there was a lot of potential for there to be tax law change. I think a lot of people remember there being concern about the capital gains tax rates going up, sort of eliminating long-term and some of those things. That was the best opportunity, in my opinion, for something like that to happen. I think with the current political environment and the status of the economy and the stock market, I think it's very unlikely that there would be any sort of negative tax law changes in the next 2 years.
Yes, that's a good hope for everyone, because we are, being a tax preparer, we are also on the ahead of the curve, right, to learn all those new things which is happening, and which is happening at a very rapid speed. Before the general revenue code was 1979 or 78, right, and after that TCJ was a big change, and we thought that is more than enough, but during the COVID, they made a lot of tax changes, right? Which is really struggle for all of us to get up to the speed on those. So the other question someone asked here regarding the market election, if someone elects 475 for the current year, it would be also applicable for the next year. And I think, as you mentioned, it is a irrevocable election, right? You can't revoke without the consent of IRS, right? Can you please shed some light on it?
They used to be irrevocable. You had to do a PLR to revoke it, but they did put procedures out where you could follow a revenue procedure and have it revoked. But absent doing that, it's in effect until revoked. So if you make the 475 election, that applies every day, every tax year there forward until you wind down the entity or revoke. I've never actually seen anybody go through with a revocation. So for all intents and purposes, it's assume it's permanent, but there is an ability to have it taken off.
Okay. I think that's pretty much it. I would say thank you to all our participants, and thank you, Alex, for sharing all the insight, and that was very helpful, even a person like me, and I hope it is much more meaningful to all the attendees. So we will be sending you the CPE certificate, and especially Alex for you too, because you participate. So I hope it will help you to get your
Thank you.
CPA license, right? So thank you once again.
Sure. Take care.